Folks, I mean, don't leave us yet, but that's all you need to know about inflation.
So much for
I
a quiet
know.
August. People think August, everyone goes on vacation.
It has not been quiet since the great financial crisis. It just hasn't.
So it hasn't been quiet for like an entire generation, basically.
Yeah, exactly.
Yeah.
It used to be.
That's cool.
All right, you're listening and watching Bloomberg Business Week. I'm Carol Masser, along with Tim Stanovic. More to come right here on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ in the red, but the S&P little change right now after a drop of almost 1% earlier in the day. Right now, we've got the S&P down 9 points. That is a decline of 0.2%. The Dow also little change, down 11 points now, down less than 0.1%. NASDAQ, the composite index, down 0.7%, lower by 92 points. 10-year yield 4.00% with a 2-year 10-year that's yielding 4.80%. Spot gold, $19.15 the ounce, lower by 0.5%. West Texas Intermediate crude above $84 a barrel right now. We've got WTI up by 1.8% to 84.36 a barrel. Well, the next big event for Wall Street will be the Consumer Price Index tomorrow morning at 8:30 a.m. Wall Street time. Complete coverage here on Bloomberg Radio. Jill Carey Hall is U.S. equity strategist at BofA Securities, and as for the broader economic picture, she told us she is not looking for a recession.
We're seeing more resilient than expected macroeconomic data. Consumers remain relatively resilient. So we're now no longer expecting GDP growth to turn negative. So we expect, growth will slow next year, but no longer officially a recession, more of a soft landing.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. And speaking of inflation, we've got Verizon raising prices on some existing wireless plans to help boost revenue and offset slumping subscriber growth. Verizon shares up today by 0.6%. Rival AT&T up by 1%. T-Mobile US higher now by 1%. Disney, the big event after the close of trading today. Disney down now by 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet with that Bloomberg Business News Flash. So you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stanovic. So this story, it did cross late yesterday. Tim, I think you might have been gone already or just walking. Tim was gone.
I was gone. My microphone was off. I was gone. My mic was off.
I was out of the studio. I was in the newsroom. I'm like, what?
Carol stays. Is this too much information? I mean, Carol's a late worker.
I'm a late worker.
Yeah. Well, you're just a long hour. You
Sometimes
work a
I
lot.
come in kind of late-ish.
Yeah. I work from home.
Yeah.
Okay, let's just say that.
I work from home.
Yeah.
So it did cross lately. It was about late yesterday. But Amazon in talks to join some other tech companies as an anchor investor in ARM's IPO, according to those familiar with the situation. So kind of part of a preparation, if you will, as they move towards this process, and we're talking about maybe a deal that could raise as much as $10 billion.
It's an interesting story. It's one that we wanted to spend quite a bit of time on. We got a couple great guests to give us all the details about it. Bloomberg News technology reporter Matt Day. He joins us on Zoom from Seattle. Also with us is Bloomberg Business Week technology editor Joshua Brustein, who's right here in our Bloomberg Interactive Broker studio. Matt, I want to start with you because you're out in Seattle, so you're physically a little closer to Amazon. Amazon as an investor, Amazon as a participant in this, does it raise questions to you about what Amazon wants to do in terms of hardware, in terms of chips, or is this purely a financial play?
Well, I think it underlines their strategy. This is strategic for them. Amazon has kind of a history of buying stakes in their big suppliers. They bought stakes in a grocery supplier when they got really big into grocery a few years ago. They bought stakes in Rivian, the electric vehicle maker, which is supplying them a bunch of electric delivery vans. So this is really part and parcel of their kind of effort to grab a slice of whatever their priority is of the moment. And if you look at Amazon Web Services, their cloud unit, they have been all about chip infrastructure for a long time. A lot of that is based on ARM. So it's just really natural that Amazon would be at least kicking the tires here.
That's what I wanted. Tim and I are looking at each other like, well,
there it
that's
is,
what
AWS.
That's what we wanted to know, right? This is about something that they use a lot of, correct?
That's right, yeah. Many years ago now, they bought Annapurna Labs, an Israeli outfit that built their own chips. Kind of a really good deal in hindsight. And a lot of their stuff was based on ARMs. That's kind of the blueprint that took Amazon into designing its own chips and kind of competing with its own suppliers, NVIDIA and Intel.
Joshua, come on in on this. Talk to us about, your tech editor here at Bloomberg Business Week, and you look at kind of the big trends that are going on and the big moves by someone like an Amazon. How do you see it? What are you thinking about when you saw this?
Well, I think this is an indication of how central ARM is to a lot of other parts of the tech industry. It makes a lot of the technology that companies that are building chips like Amazon need to make their own chips. And so I think what you're seeing here is that everyone wants to make sure that they are, maintaining that relationship. It has important relationships with a lot of other large companies. I know Intel and NVIDIA have also been having discussions with ARM about similar deals. And I think that is just showing how central this company is.
Didn't NVIDIA, right, try to do a deal earlier, wasn't it?
Yeah, so
right?
Before ARM decided to go public, it actually had reached a deal with NVIDIA to sell to NVIDIA for $40 billion.
Right.
And everyone else in the industry got so concerned that, well, if NVIDIA owns this company, what's going to happen to us? there was pressure on regulators, and NVIDIA ended up walking away from the deal.
Okay, well, that's a perfect segue to my next question for Matt, because Matt, I'm old enough to remember.
You're welcome, Tim.
Thank you, Carol. I'm old enough to remember, and thank you, Joshua. I'm old enough to remember when Walmart told its customers and suppliers a few years ago, hey, we want you guys to distance yourself from AWS, because AWS is owned by Amazon. It's the profit center for Amazon. They're our biggest competitor when it comes to online shopping, when it comes to shopping. Does this at all have the same kind of risk for a company like ARM, that it could drive away some customers who are told, hey, we don't want to support a company that's a competitor to us?
No, I'm not sure. ARM stuff is so widely out there, and there are already so many, as we reported, people with interest in backing ARM, right? Everyone kind of wants a slice of this. ARM's existing competitors, ARM's other customers potentially. I think Amazon's already kind of got its hands in so many pies, so to speak, that there's not many people who are not thinking they're a competitor today. Yeah, they're just everywhere and everything.
I'm just thinking about the semiconductor space, and thank you, NVIDIA, in a long way, and kind of the amount of time we talk about artificial intelligence and the need for chips in that. But I'm looking at the stocks; it's up 43% this year, and I just think about the whole chip space. We increasingly talk about that everything we do, everything we make, it's all got so many different chips in it. And just how important that is to our economy and just so much that we make and do here.
Yeah, absolutely.
Sorry, there was no question.
I do think that is what makes ARM interesting. And you see a company like Amazon wanting to build its own chips for its own purposes.
Like Apple, right?
Yeah, absolutely. And having something like ARM that is a basis for a lot of companies getting into the chip space is an indication of just how much everyone needs to do something for their business with chips, and this gives them the chance to do so.
Matt, safe to say though, so not a surprise to see Amazon involvement, and it makes more sense if there's not only Amazon but some other big players, especially if you think about regulators maybe looking at this and getting a little nervous. Or not?
No, for sure. And if anything, it sounds like it validates Amazon's strategy a little bit. A lot of people were looking at AWS a few years ago and saying, are they going to go up the stack in tech speak and take on Microsoft and software or services? Amazon's kind of gone the opposite direction, right? They want to go down to the hardware and the silicon, and they think that's a more robust long-term bet. And really, since then, everybody has followed them down that track. Microsoft is working on designing its own chips. Google has a deal with ARM separately, right? Everybody's kind of going after this same pie, and all these companies would argue that it's competitive enough that there's not necessarily antitrust concerns here.
Joshua, ARM's IPO could be the largest in the tech industry if it were to price the top end of estimates, going all the way back to 2014 when we saw Alibaba and Meta platforms, then Facebook in 2012, formerly known as Facebook Meta Platforms. Now, does that herald a new wave of tech IPOs potentially, or is this kind of a one-off rather than a return to what we saw pre-pandemic?
I think it's probably more of a one-off. ARM has been looking for some sort of exit for quite some time. And I do think the size of it is an indication of how central chips have really become and how they're seen as the most important part right now of the tech industry. Whereas, as you mentioned, Facebook in 2012, it's hard to think of a really huge social media IPO happening in the near future.
Well, and I'm looking at this story.
But TikTok, maybe.
I guess, yeah, TikTok.
Yeah,
would
but
be
other than
that,
but you're right. Other than that, there's if you think about advertising, and it's just and it's also dominated by 3 companies.
Yeah, absolutely.
Well, Matt, and I also think about how, in this story that's out on the Bloomberg by Nick Turner and Spencer Soper, just reminding us that ARM CEO, that one of the goals is to get more into the data center market. And if you think about data center, right, AWS plays right into that.
That's right. And that's a space that Intel has historically owned, right? Their chips have been the typical, reference chips that wind up in all the servers that power email and Netflix and all that kind of thing. Increasingly, ARM is competitive in that field. So this makes sense in that lens.
So Joshua, when do we get a cover? I don't know, what's the cover about the chip space? How are you guys thinking of Business Week? I always think about, what I always love when you guys come in here, it's what are the conversations you're having? Because it just does seem like, I think we're going to get to December, and somewhere we're going to be when we talk about the big themes, it's going to be, we still have a few months to go, but what has gone on in the chip space in general, led by NVIDIA? Yeah,
I think the interesting thing about chips right now is that they're tied very closely to the 2 other really big tech stories right now, which are the conflict between the U.S. and China, and also the increasing rise of artificial intelligence. How the details of the way that semiconductors factor into that is critical in understanding both of those other big subjects.
Hey, Matt, before we go, anything we're hearing from Amazon on this?
officially they're not telling us much of anything. They are really keen, though, to emphasize that, they think their competitive advantage, or a big part of it in AWS, is chips. So this is the spot. Whether or not they invest in ARM, they're going to stick around for a while.
All right, well, we'll be looking for the red sticky to cross the Bloomberg to see whether or not this goes ahead. Hey, guys, thank you so much. So appreciate it. Matt Day, he's tech reporter here at Bloomberg News on Zoom from Seattle. Find him on Twitter on X, on Matt M. Day. I can't do it.
Fine.
Can you do it? Joshua, can you call
No,
X?
it's tough. I'm still working on Meta myself.
Yeah, so am I. If you saw me earlier, I was like Facebook, Meta, 2012.
I've gotten alphabet down. I can say alphabet now.
Yeah, I'm
X,
probably good with
Y, Z.
alphabet. Stop this X. All right, Joshua Brustein, of course, technology editor at Bloomberg Business Week. Find him at Joshua Brustein on
X, Twitter.
Not
All
gonna
right,
do it,
we
not doing
find her in Washington, D.C. today. Let's get a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom. Hey, Nance.
Thanks, Tim. Well, court documents released today reveal that special counsel Jack Smith obtained a search warrant back in January for records related to former President Trump's Twitter account, and a judge apparently levied a fine of $350,000 when Twitter took its time complying with the request. The filing says the court found probable cause to search the Twitter account for evidence of criminal offenses. Well, included in the latest indictment of Donald Trump is reportedly a previously unknown memo outlining a plot to use false state electors to overturn the 2020 election results. The New York Times reports it was drafted by one of Trump's unnamed co-conspirators, believed to be his attorney Kenneth Chesbrough. Bloomberg government's Jonathan Tamari says the memo will be used to bolster the special counsel's charge of conspiracy.
We've heard a lot about this, but this specific memo had not been uncovered before. One of Trump's attorneys writes in it that he realizes that his suggestion is bold and controversial, that it might not work, but that they want to pursue it as an option to keep Trump in office.
Bloomberg government's Jonathan Tamari. Trump has argued that the prosecution is unfair and another witch hunt. If you're a walker, a study published today in the European Journal of Preventive Cardiology says walking about 4,000 steps a day can start to reduce the risk of dying from almost any cause. Walking a little more than half that amount can help reduce the risk of dying from cardiovascular disease specifically, and increasing that amount could reduce mortality by about 15% for each additional 1,000 steps. Well, there is finally a winner. Last night's Mega Millions record-setting drawing of $1.58 billion. The winner bought their lucky ticket at a Publix in Neptune Beach, Florida. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. 20 minutes to go ahead of the closing bell. With the Dow, the S&P, NASDAQ all in the red. Stocks are churning, but let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
Good afternoon, Charlie. As you said, stocks are trading lower as traders position for tomorrow's inflation data. The Dow is down 50 points, S&P lower by 15, with the NASDAQ sliding 100 points. The U.S. 10-year yield is at 4%, and small caps are down 5. 6 of the 11 main S&P sectors are trading higher, though, led by gains in energy and real estate, while tech and consumer discretionary are the worst performers. NASDAQ biotechs rise 15 points, transports slip 70, semis are down 50 points, while the VIX is lower by 3%. Leaders in the Dow, Dow Inc., Honeywell, and Caterpillar, while Salesforce, Intel, and Goldman Sachs are the worst performers. On the earnings front, Roblox plunged 22% after daily users on the video game platform fell. Celsius climbed to a record after the energy drink maker beat estimates. Axon jumped 15% after Taser and body camera sales drove an earnings beat, while Lyft fell after its slowest revenue growth in 2 years. In other news, WeWork sank 40% to a record low after a going concern warning. Wrapping things up, look for earnings from Disney, Illumina, and Trade Desk after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey. And to hear live breaking news over your Bloomberg, type SQUAWK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It drives me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left, under 18 minutes left in today's trading session. Carol Master along with Tim Stanovic here on Bloomberg Business Week on Bloomberg Radio, YouTube, and Bloomberg Originals. Bouncing around on the equity trade, still down across the board, but off our best and worst levels of the session. Another big batch of treasuries being sold, 10 years. That 10-year yield, as you just heard from Charlie, 4 even, if you will. And we are definitely near our lower levels of the session. So I think we should get to it.
Yeah, we got Paul Christopher with us, head of global investment strategy at Wells Fargo Investment Institute, joining us on Zoom from St. Louis. Paul, good to have you with us. How are you?
Hey, thanks. Good to be with you.
Well, Romain kind of said this earlier, Carol, at the top, that, today's kind of a repeat of yesterday, at least when you see the equity trade, where you think it's going to, you come in the morning and stocks kind of crater, in quotes, because it's kind of what we're seeing relative to what's happened this month.
Yeah.
We're not talking financial crisis here.
Backing off a little bit.
22, backing off a little bit. But then as the session keeps going,
Have a treasury auction that seems to go
you have a treasury
well.
auction, seems to go well. Dow gets into, the green.
Mm-hmm.
What's going on, Paul? It's like kind of seeing, it's like things are moving sideways a little bit. It's weird.
Well, as much as equity investors would like to wish it were so, the equity markets really can't get away from the whole rates picture. So, if you get a downgrade of the U.S. and all of a sudden rates start to move higher, what's that going to hit? It's going to hit tech in equities. If you get concerns about inflation maybe popping a little bit higher, maybe the June 3% number was the low for the year, maybe that starts to make people second guess some of their positions, and they're going to start to trim. So we're definitely seeing some positions squaring ahead of tomorrow's CPI report, and there's definitely a close eye being kept on all of the treasury auctions because of the concern that there's simply too much treasury debt to be issued in the coming weeks and months.
Yeah, a lot, right? We're talking about $38 billion in terms of 10 years today, and you still have that 10-year hovering near 4%. So it's certainly something we're keeping an eye on. Let's stay with the inflation story. We talked about it at the top of our broadcast, Paul. The move up that we are seeing in crude oil today, specifically, oil a 9-month high, concern about where this goes, concern about the tensions overseas. How important is that to you? On the equity side, we are seeing energy or outperformers today. And I don't know, is it a longer term concern play here or just maybe a blip?
It's really a couple things. I mean, if you're going to have concerns about energy internationally, maybe the fear that Russia won't be able to export as much oil because the Ukrainians are targeting them, or maybe it's because the Saudis have committed to keeping their current cut and maybe doing even more than that, even as Chinese demand remains pretty solid. That's going to put upward pressure on energy prices, which in turn feeds back into inflation in a number of ways. The July inflation print tomorrow may not even be the one that investors are going to worry about the most. It might be August, September, October, where you start to see inflation bubble back up a little bit. Not a new trend, but just maybe making the 3% in June the low for the year. And that really accentuates some negative trends in especially consumer spending. Where you're going to have higher energy prices, higher inflation. The trends there were already negative. Maybe it starts to cast a little bit of a shadow over the soft landing scenario. Maybe it keeps the Fed more in play. And so you're just seeing some uncertainty for equity markets here. And that's why I think you're seeing the decline earlier in the day, and then maybe some people come in and buy the low.
It's very reactionary. It's very reactionary, it feels like, too.
That's what I was going to say. I mean, 2 weeks ago, Carol, last week, I mean, the narrative after we heard from Jay Powell 2 weeks ago was basically, okay, we're going to toss our recession concerns out the window. The Fed, in fact, has removed a recession concern from its base case. We saw a lot of analysts in the wake of that over the last week, in fact, do that and say basically, okay, wait a second, everything's fine. There could be one more rate hike this year. Then the Fed starts to cut in the early part of next year. What has shifted, Paul, just in the last few days that's giving people the jitters?
Yeah, it's really that fear of inflation. And it's funny you mentioned the Fed. If you go back and look at the last 3 recessions, there were always people ahead of time talking about a soft landing. And some of those people were Fed speakers. So I wouldn't necessarily put a lot of stock by what the Fed happens to think about recession or not. You have to watch the data here. But if inflation does perk up a little bit, it weighs on consumers. It puts the Fed and rate hikes back in play. So it's just a concern.
But is inflation picking up because people are buying houses and buying stuff to put in houses? And so is that kind of the quandary that we are in as we talk about sometimes the data just kind of goes in different directions? I mean, people are still working. I find that for most individuals, if you've got a job and feel confident about it, you're going to feel pretty confident about spending ultimately. Not for everybody, but that seems to be a big indicator that maybe keeps the momentum possibly going.
Possibly, and you're certainly right to look at the consumer here. But if you open the hood and start looking around in the engine, you start to see that the spending trends aren't really all that positive as they seem. Consumers are buying more spending more on discretionary than they are on essentials. That's not a sustainable trend. You start to see credit applications being turned down in greater numbers by banks now. You're seeing more delinquencies in credit cards and auto loans. You're seeing even in the labor market where people are getting jobs and wage inflation is still running at a pretty healthy 4%, but hours are getting cut. So total labor income, hours times wages, that's actually growing more slowly. The trends in the consumer are more negative than they appear.
So what is it sounds like you're actually pretty concerned about this, Paul. What is an investor?
We are still calling for a recession.
Yeah.
Sorry, say that one more time.
I'm sorry, we're still calling for a recession.
When?
Maybe later this year or early part of next year. It's not going to be a 2008 style recession. There's still a lot of cash, and you're right that there's still some spending going on at big corporations and wealthy individuals, but the strains on most other consumers are really growing.
All right, 25 seconds, your best investment idea right now.
Stay focused on quality. We like energy here. We like healthcare. We like materials as sectors that will generate revenue and cash for dividends.
Did you like energy before the bump up in today's trade, or?
Yeah, we suffered through the decline in energy prices earlier this year. We feel a little bit vindicated now.
All right, good to check in with you. Paul Christopher, take care. Head of Global Investment Strategy at Wells Fargo Investment Institute on Zoom from St. Louis. Just about 10 minutes left in the trade. Carol Master, Tim Stanovic. This is Bloomberg Business Week.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Walt Disney will be reporting earnings after the close of trading. The report comes a day after Disney announced that ESPN has signed a long-term exclusive agreement with casino operator Penn Entertainment, licensing its brand for sports betting and deepening the media giant's ties to the growing online gambling business. Michael Nathanson is senior research analyst at MoffettNathanson. He's got an outperform rating on Disney stock with a $120 price target.
This is a deal where ESPN gets $1.5 billion and some warrants, but I do think it's a predecessor to finding new partnerships and trying to reposition ESPN off of their books in partnerships with other companies.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. WeWork shares are plummeting after saying there is substantial doubt about its ability to continue operating. The company cites sustained losses and canceled memberships to its office spaces. WeWork down now by 40%. We've got Lyft shares lower after the company reported its slowest revenue growth in 2 years, overshadowing a better-than-expected outlook for earnings as the company struggles to get its ridership back on track. Right now, Lyft shares, they are trading lower by 9.5%. San Francisco-based crosstown rival Uber down now by 2.1%. And those are some of the top stories we're following for you at this hour. And this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovic on Bloomberg Radio.
All right, everybody. Carol Masser, Tim Stenovic, live here at Bloomberg headquarters in New York City. In just a moment, we're going to head over to our TV colleagues from Maine and Scarlett. We're going to count you down to the close on this Wednesday. We've got Disney earnings, we've got Lionsgate, we've got Canopy growth, and we also have Wynn Resort. So we'll break those down. Disney, obviously, the big one.
It's the big one.
It's the big
It's the
one.
Magic Kingdom, Carol.
Speaking of the big one,
Yes.
I guess you didn't win.
I didn't win. I bought a ticket last night, and
Me too.
Yeah, it was not a winner in New Jersey, not a winner in New York.
I'm gonna I feel like I want to go to my place. I'm like, I won $4 last week. I'm like, nobody wins. Does anybody win
I
here?
talked to the woman last night who sold me. She, works she owns the bodega right by our apartment.
Are you
and I
like, does
said-
anybody ever win?
Yeah, she said sometime, somebody won like $50,000 a couple of years ago, so they got a cut of that. And I was like, I'm gonna win this tonight, and you're gonna get money.
No, you didn't.
I didn't win. Yeah.
Bummer.
Yeah, it's such a bummer.
Florida.
Florida.
Come
Yeah.
on.
Okay, $1.58 billion.
Yeah.
It was reportedly bought, the ticket, in a public supermarket in Neptune Beach, Florida. It's going to pay out $783.3 million in cash, according to a Mega Millions statement. This prize was claimed after
Wait, is
31
that after all the
failed-
taxes? Is that the federal taxes are gone? Because they take a haircut right
Yeah,
off
but
the
I don't know
top.
how lotto winners are taxed in Florida.
All right, I don't know either. There's no taxes in Florida.
Maybe there are for lottery, because some states do tax lottery,
Yeah.
some states don't. It doesn't have to do with
New
income
Jersey,
taxes.
New York have like a 9-10%, I think. off of that.
Shocking.
Yeah, no.
Yeah, shocking that New Jersey and New York.
Wait, they
would-
tax a lot
they
here in the
tax-
New York
I
Metro?
had no idea. Had no idea.
From two people who are tired of paying lots of taxes.
The prize was claimed after 31 failed drawings and exceeds the prior Mega Millions record of $1.54 billion. That was in South Carolina back in 2018.
It's really wild because I feel like every day or every couple of days, right, like nobody won. And we all like, go back. I'm like, we're still doing this. Biggest winner of the Powerball jackpot was $2 billion in November. That player was based in California.
Mhm.
Also based in California.
Yeah, that would be.
Wait, which
taxed.
one was that one?
Yeah, that was last
Oh.
month. That was Powerball.
Oh, sorry. That's right.
Yeah.
Sorry.
I don't even know these different these different games. I went in and I just said, "Can I buy a ticket? Can you just get me the one for the big one?"
I always wonder if they're going to be like, oh, yeah, play this game. Like,
That's the wrong one.
Because I'm an idiot. I don't know.
I can't remember which one's which. I'm just like, give me the big one that everyone's buying tickets
Get to work
for.
on
It's
your lottery game.
1 in 300 million chance of winning, and I'm gonna fantasize
Should I
about winning.
supersize it? Oh, no, that's fast food. Like, it's like, right, there's that thing you can do, right?
Hey.
Like the multiplier effect.
It's a real business.
It's a real business.
For the States.
We are in the real business of tracking the markets, and we're going to count you down to the close in just a moment. Also break down those earnings. Stick around, everybody, because Beyond the Bell, it starts right now.
Price action not holding up here as we move closer to these closing bell. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Masser, a non-smiling Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio, Originals, and our partnership with YouTube. Carol, last time we spoke, I was saying that it looked like this market was actually kind of ready to punch into the green. We've drifted lower, and right now we're right near session lows across the board.
Yeah, we're just talking to Paul Christopher over at Wells Fargo Investment Institute, and he said it really is kind of a news-driven market, and it can change at any moment. It just feels like the tone of the market has changed a lot, and whether it's news about concerns about banks, we've seen that play out in the market, whether it's concerns about inflation or energy prices, it feels like the news momentum can change from hour to hour.
I mean, speaking of tone, his tone with us was one that was really defensive, really, I don't want to say pessimistic, but really cautious. I mean, they're still calling for a recession at Wells Fargo.
Not like 2008.
He said not like 2008. He said even later this year or early next year. He says consumers are really strained right now.
Yeah, there's a lot of commentary about how we still haven't seen the full effects of all these interest rate increases, and it's going to start being felt later on this year. But we've heard that for all this year as well.
Yeah, absolutely. And I think, maybe there is a bit of a holding pattern here as people really do want to see that CPI report tomorrow morning, whether that you get that reacceleration in inflation that some people thought, or whether that downtrend continues. And of course, whatever Fed commentary gets baked into it after we go. We should point out that we did actually open higher on the S&P 500, only by a fraction of a percent here, and never really moved much off of that. At one point on the day, we were down by about 0.9%. It looks like right now, as we get the closing bells, we're going to close lower by 0.7%. Down about 32 points, or about 44.67 on the S&P. The Dow Jones Industrial Average down about 200 points, or 0.5%. And we should point out the NASDAQ Composite down 1% on the day, but the NASDAQ 100 also moving lower here on the day by a similar amount and breaking below that 50-day moving average, first closed below that 50-day moving average since March of this year. The Russell 2000 also lower on the day, Carol, by about 0.9%.
All right, and as expected, a headline crossing the Bloomberg terminal. President Biden signing an executive order limiting U.S. investment in some Chinese firms. It's all part of a push to restrict the country's ability to develop next-generation military and surveillance technologies that might threaten U.S. national security. Scarlett, we continue to see the tensions really rise or kind of stay consistent, if you will, between the U.S. and China.
Right. As long as it moves in this direction, I guess it's all priced in because people had anticipated some kind of action here. What would be a game changer is if suddenly there was a return to some sense of amity between the two countries. Let's take a look at the industry group performers here, because you've got energy stocks at the very top there. They've been the outperformers all day long as oil prices climb towards $85 a barrel. Telecommunication services, there we go, up 2/3% as well. On the downside, the chip makers, notably NVIDIA, has been a big drag, off by almost 3% as a group, and autos also a big laggard too, almost down by 3%.
All right, folks, to some of the individual gainers as we await those Disney earnings. Got to talk about Penn Entertainment rallying up about 9%. It was up as much as 18% earlier in the session. We know the news after the close yesterday, signing that $2 billion U.S. online sports betting deal with ESPN, and so it really got a kick to the upside. So, of course, we'll wait to see if we hear more about that on the Disney earnings release and call. I do want to mention Celsius Holdings up 20% in today's session. The energy drink company posted second quarter profit and sales that topped expectations. Stock is up about 70% year to date, and I do believe, I know it was an all-time high on an intraday basis, but you got about 21% of the float is shorted. Let's go to, if we can, to some earnings, because Wynn Resorts is just crossing the Bloomberg terminal. Macau, their revenues there will be really important. Second quarter adjusted EPS, folks, it's a big beat, 91 cents a share. The estimate was for 62 cents, so 29 cents higher than what the street was expecting. Second quarter operating revenue, 1.6 billion. That too is better than the forecast of 1.53 billion. Adjusted property EBITDAR, it was 524.5 million. That was a beat over the 456.5 million forecast. And second quarter Las Vegas operating revenue, 578.1 million. 587.2 million was forecast. So that's a little bit light, but nonetheless, that stock is up almost 3% here in the after hours. And we'll wait to see if we get, guys, some numbers when it comes to Macau.
All right. We're still waiting more earnings, notably Disney. In the meantime, let's go through some of the decliners. The notable decliners, there were no no shortage to choose from. Scarlett, you hit the nail on the head when talking about the chip makers being under pressure today. NVIDIA finishing the day down by 4.7%. Semiconductors taking a hit. This after shares of Super Microcomputer fell by more than 20% after it posted results. Also, WeWork down 38.5% today. Wow. This is after the company yesterday, after the market closed, saying that there's a substantial doubt of its ability to continue operating. It's lost 98%, Carol, of its market cap since it went public. I mean, this was the darling of the startup world back, in 2017 when it had a valuation near $50 billion, and now it could be, a substantial doubt that it could continue as a going concern. It absolutely is. Questions, too, about what it does to commercial real estate here in New York City and many other cities that it has long-term leases in. Lyft shares down 10% today. The company did report its slowest revenue growth in 2 years, actually overshadowed a better-than-expected outlook. We covered it late yesterday when the company did report earnings, and everything that it's trying to do to get riders back to taking lifts once again.
Yeah, let's take a quick look at what's going on in the yield space. A bit more muted price action there relative to some of the other markets out there. You did see a downtick in yields on the longer end of the curve. The 30-year yield down about 4 basis points. Similar story for the 20-year and 2 basis points on that 2-year. However, you did see an uptick in yields on the shorter end of the curve with the 5-year up by about 1 basis point and the 2-year up by about 5 basis points, Carol.
All right, so let's get to, what do we want to talk about, guys?
Well, here, I'll just jump in here, Carol. Yeah. I do want to get just highlight Trade Desk. I know we're waiting for some earnings out of Disney, but we were talking a little bit earlier about the digital ad space, this on the back of some interesting commentary about what's been going on with PubMatic and a few others. They just came out with their earnings. Those shares down in after-hours trading here. Now, the 2Q numbers did come in above estimates, both in terms of EPS and revenue, but the 3Q numbers look like they come in a little bit light, and that's raising some concerns about advertising writ large, advertising softness that could affect Disney as well. Walt Disney actually out with its earnings right now. Let's go right to that and take a look here at what we learned for the fiscal third quarter. Let's start off with Disney Plus and the subscribers that it has in the third quarter. A miss. 146 million subscribers to Disney Plus. The street was looking for 155 million. So that's a miss. Adjusted EPS coming in at $1.03. The street was looking on average for 99 cents. So that is a beat. Revenue overall for the fiscal third quarter, $22.3 billion. That's pretty much in line with what the street was looking for here. We have to, of course, we know, guys, go through all these different segments here to get a better sense here of what is going to happen with the company, and we're not getting a forecast just yet. So it'd be interesting to see how this all breaks down in terms of the strategy going forward. I know, Carol, you've already patted Bob Iger on the back for a job well done, but he's still got a lot of work ahead.
He's got a lot, and certainly people are going to be asking questions still about streaming, right, where they've lost a lot of money. He is trying to do a lot of things. He's trying to buy back all of Hulu. I'm looking at the press release. Bob Iger making some commentary. He says, in the 8 months since my return, these important changes are creating a more cost-effective, coordinated, and streamlined approach to our operations. So he says these results are reflective of what they have done, and they're talking about this transformation.
Well, let's get back to a couple things that investors are looking at with regards to the losses in that direct-to-consumer business, basically the streaming business. They're basically saying that the direct-to-consumer operating loss was $512 million. Believe it or not, that's a smaller loss than what the street was looking for. They were looking for a loss of about $778 million. The company also says that it took a charge in the fiscal third quarter of about $2.4 billion on content removal from its direct-to-consumer operations. Not exactly sure what that means here, but we do know that Bob Iger has talked a lot about getting costs in line with what he thinks is going to be commensurate with better growth here. So maybe this is a sense here of where he finds some of the fat, Scarlett.
Right, and the cost cutting is to the tune of $5.5 billion, and Bob Iger mentions that, saying that they're on track to exceed the initial goal of $5.5 billion in savings. Just keep in mind that for the quarter gone, there are a couple of other one-time charges that are going to hurt the bottom line, including the write-off tied to shutting down the Star Wars-themed hotel at Disney World. I mean, that was an expensive venture. There was also the weaker U.S. box office overall. There seems to be some fatigue around the Marvel and Lucasfilm properties. The Indiana Jones movie didn't do all that well. I liked it, but not enough enough people.
You went and
liked it.
actually saw that?
I did.
Oh, okay.
It was,
So you were the one.
Scarlett, you should have gone a few more times.
Because I
guess
literally
so.
think it sold like about $27 in tickets.
Guys, I still can't get past the Disney Plus subscribers for the third quarter. I mean, this is a major miss, coming in at 146.1 million versus estimates of 154.8 million.
Yeah.
How is the company not only going to get subscribers back, but also cover the costs that continue at its streaming division? I mean, this is one that is so important to it.
Well, that's what I'm curious about, because all the talk here is about the cost cutting, right? The idea that you spend less on content. Obviously, you have the writers and actors strike, which is going to limit that as well. But as I'm sure everyone knows, is that the value proposition, at least for a customer, is that there's got to be a fire hose of content. That's what made Netflix Netflix. If the content isn't there, why am I going to continue to pay?
I want to know about this 2.4 billion for content removal, because that's what's interesting. I'm looking at, they're talking about these restructuring and impairment charges related to the removal of content from our DTC services. You talked about this. Termination of certain third-party license agreements for the right to use content. So I want to kind of know about this, because as you guys say, it's all about content, right, to get us there.
Yeah, I mean, I hope people like reality TV, because with the writer's strike, that's what we're going to see.
Hey,
really?
Yeah.
Oh gosh.
by the way, the stock, which
Or you
is
could just
down,
watch. Or what about news, Tim?
this is reality TV.
Okay.
you only need Bloomberg for news.
Does Carol know she's on camera?
I know. I move around a lot. I'm a mover. The stock is just down about 0.2%. So we're coming off some of our lows. So it feels like we're trying to make sense of what it all means. All right, we got to go. All right, that's a wrap. More to come, though, on both sides. TV, radio, originals, and, of course, on YouTube. That's a wrap, though, for Beyond the Bell.
Now, your company news headlines on.
All right, guys, we're going to stay with Disney because we're trying to make sense of it. And two of our colleagues walking into the studio, they're reading in big time because there's a lot when it comes to Disney. A lot of moving parts. Stock is still down about 1% in the after hours, but it's off its lows and it is bouncing around. So let's get to it because it is kind of a changing empire over at the Magic Kingdom. So let's get to it with Bloomberg News media reporter Jerry Smith, along with Bloomberg News markets reporter Abigail Doolittle, both in our Bloomberg Interactive Brokers studio. Now down about 0.3%. Again, bouncing around. Jerry, what jumps out for you?
Cost cutting. I mean, I think that the profit beat was in large part due to cutting costs. One of the big areas that they are cutting costs is in streaming. This is a business that's
Is that the 2.4 billion?
This is a business that's been losing lots and lots of money. Everyone in the industry is losing money on streaming, and they're under a lot of pressure from investors to try and find some path to profitability. So Disney is getting there.
But are they getting there fast enough? I mean, it's interesting to see the bottom line beat, but they didn't do that by getting more than expected subscribers to Disney Plus. In fact, they came in about 10 million subscribers short of what the street was estimating, Jerry.
Yeah, I mean, the Disney Plus numbers were actually affected by, in India, they didn't renew cricket rights, which is a huge sport in India. And so Disney Plus, it's the Hotstar business over there, and they lost a lot of subscribers over that. So that's largely why we saw the decline in Disney Plus subscribers.
I want to bring you in a second, Abigail, but I want to understand. So the 2.4 billion related to the removal of content was just saying goodbye to agreements in terms of putting content on some of their services. Is that what that is?
Yeah, I mean, that's something we've seen in the industry. Actually, a lot of different companies now are used to think that if something shows up on a streaming service, it's there forever. But media companies are finding that if they can remove some of that content from their streaming service, there's some financial benefits to doing that.
But even though it costs them something to remove it.
Yeah, I'm not an accountant, but
I'm trying to. I'm sorry. I know. I'm like drilling you. I'm trying to understand it.
Jerry Smith, CPA.
Yeah.
I'm just trying to, because I think this is why.
I think it makes sense that you want to understand it, because coming into this quarter, and I'm far less of an expert than you, Jerry, by far, but my understanding was that a lot of people want to know that the numbers overall were going to be less important, that it was going to have a lot to do with what Bob Iger says the plan is for the plan around the media assets, and particularly the media strategy overall, and that all of these movie flops that they've had, what are they going to do with the linear channel, just basically some strategy there. So in terms of, I can understand why you would want to know that specificity, Carol, but I think, Tim, I agree, just as somebody who is going to be looking a little bit more of a surface level, and I think that's what the stock is reacting to, that Disney Plus subscriber miss.
It's down 2% again.
Yeah, it's down, and then it's actually, it's down, it's kind of all over the map, but yes, it's down around about 2%. And as I break it down, it looks like there's some subscriber there's some weakness for some of the other areas as well relative to subscribers. One bright spot, though, I don't know if you agree with this, Jerry, though, is parks, because I was speaking to one analyst who was saying that parks are really important because there had been some ad hoc reports coming into this quarter that we had all of this revenge travel spend, and that had kept parks high. It's about, as you know, 35% of revenue, but 70% of profits. But parks actually beat, so that's a little bit of a bright spot, maybe.
Yeah, I mean, compared to the TV business, which is really where Disney's struggling and trying to figure out what it's going to do next. Bob Iger gave this interview in Sun Valley a few weeks ago, and everyone in the industry has been chewing this over. He essentially put up the for sale sign on the TV networks, which include ABC. He said he's not going to sell
It's
ESPN.
shocking, right?
Yeah,
Okay, but isn't ESPN, isn't that a consideration?
So he's looking at a strategic partner for ESPN, but
Okay,
he
so
said that other TV networks may not be core to the business, which is really saying that he's willing to unload it at the right price.
It seems, yeah, it is shocking, especially
You think
after
about
he
this-
spent so much money on beefing up those TV networks with the 21st Century Fox stuff, Jerry, years ago.
Right. I mean, that was just a few years ago, really.
Yeah.
I mean, it shows you how much has changed. And I think people are going to be listening carefully to this earnings call because, yeah, I mean, Bob Iger is, trying to figure out what he's going to do with this shrinking TV business.
But what is the streaming business without those TV assets? Because the TV business gives it content.
The studios give our producers
So they
content.
could sell the TV parts and still have robust slate of content for the streaming business.
Yeah, I mean, there's studios and can still produce for the streaming services. The TV networks, I mean, that's a more challenging business.
Okay.
A lot of the revenue that the TV networks get is from cable subscribers, and as we all know, cable subscribers are shrinking quite rapidly right now. So I think people are going to be listening very closely to what he says about that.
Abigail, come on in. Again, like you say, the stock jumping around here. It's now 1.7% lower. It just keeps bouncing. You were reading a lot of analyst commentary, reading in. Kind of, cross it with us in terms of what you were expecting coming in and then what we're seeing.
So a number of analysts said that this is one of those quarters where numbers just don't matter. Whenever I hear that, I get a little bit nervous because at the end of the day,
Numbers always matter.
they are always going to matter. So, we do have this nice profit beat. On the other side, the revenue miss and the subscriber miss. And I do think that that is what's weighing on the stock right now. But to Jerry's point, I think that the conference call is going to be critical in terms of what color do they give around. I mean, I think from an operating standpoint, that's mainly the park standpoint. So based on just looking at the numbers here, that seems to be a positive. But in terms of media, what are they going to do? And also, speaking about content, and so it'll be interesting also to hear about these strikes, because I was talking to one analyst who was saying that there could actually be a near-term pop for these companies in terms of content costs coming down because of the strike. It would obviously be a Band-Aid as opposed to something more. But they've had, some of these movie flops. Like, do they have to change management in movies to get better content?
It seems like a double-edged sword, Abigail, because I look up shows that I want to see the next season of, and I find out that this show
Come on,
was filming.
Tim, you watch The Bachelor or Bachelorette. You could be honest with us.
I can't stand reality TV. I'm like, I'll
You're
watch
so
the golden
missing.
era of TV till the day I die. But like the reality TV stuff, I can't. But it's a double-edged sword, Abigail, because without the actual content being created, then the demand for these services goes down.
That's exactly it. It's a race for content. And it has been from day one of Netflix once they started streaming. Without that content, and I have to tell you, I think that some of you know that I'm a Netflix disc person. The first time that I was forced to go on Netflix streaming, I was like, this is a short, and that was actually before it fell. There's like 10 things on, I mean, not literally, but like relative to the plethora of what you can actually get on Netflix discs. So yeah, it's still a race to content. How do they balance that?
But Disney doesn't need the TV networks to produce content. They can do it, right? We see it, Netflix, Amazon, they don't have TV networks, right? And they create some incredible content. I want to ask you, though, about Kevin Meyer, I'm not sure I'm saying it right, Tom Staggs, right, who were both senior at the company. Staggs was once an heir apparent or in the race for it.
So was Mayer.
No, I know, so both of them. But so
Maybe they were again.
But they came back to the company. Iger brought them back. What do you think about them and those hires?
Yeah, I mean, there's a lot of intrigue there since they were passed over to become Bob Iger's successor, and now they're back as consultants, helping Bob figure out what he's going to do with the TV networks. But I think it's been well documented that Bob Iger has struggled to find a successor for himself. The first time he did it, Bob Chapek ended up getting pushed out. So, now that two of the candidates that were potential successors before, now that they are back in his inner circle,
I don't know.
Oh, okay.
Sorry.
Streaming. What are you going to do with streaming? Stock's down about 1.5%. Abigail Doolittle, Jerry Smith, thank you.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. We are keeping an eye on shares of the Walt Disney Company after hours. Disney right now trading lower by 0.9%, has been bouncing around. Disney reported third quarter earnings that exceeded analyst expectations, benefiting from cost cutting and a narrower loss in its streaming TV business. Now, subscribers to the Disney Plus streaming service tumbled 7.4% to 146.1 million for census that analysts had expected. So it raises the question, what happened with Disney Plus? Jerry Smith covers media stocks, including Disney, for Bloomberg News, and he was interviewed moments ago right here on Bloomberg Business Week.
The Disney Plus numbers were actually affected by, in India, they didn't renew cricket rights, which is a huge sport in India, and it's the Hotstar business over there, and they lost a lot of subscribers over that. largely why we saw the decline in Disney Plus subscribers.
And again, Disney After Hours down now by 1%. You can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcast. Points there of 0.5%. NASDAQ down 162, a drop there of 1.2%. 10-year yield 4.00%. 2-year 4.80%. Spot gold 19.15 the ounce, down by about 0.5%. West Texas Intermediate crude up 1.6%. 84.26 for a barrel of West Texas Intermediate crude. Again, checking Disney one more time, lower now by 1% after hours. We've got you covered on Disney. More coverage coming up. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It's a busy one. All right, Charlie, thank you so much. Carol Masser, along with Tim Stenovic, live here on Bloomberg Business Week. A lot going on, and we're watching those earnings in the after hours.
Oh, those old things?
Yeah, those old things. We'll bring you any headlines that you need to know. In the meantime, we want to go back to how we began our broadcast about an hour and a half ago and talking about the CPI report tomorrow. It's definitely a focal point for investors and markets, and we definitely saw it play out in today's trade. And in keeping with that, Tim, there's a really interesting story on the Bloomberg about one place in the U.S. that has actually put inflation in the rearview mirror. They've done it rather fast.
Yeah, and it kind of makes sense. It's logical how they've done it. We're talking about Minnesota. So in May, the Twin Cities became the first major metropolitan area to see annual inflation fall below the Federal Reserve's target of 2%. Its 1.8% pace of price increases was the lowest of any region that month, and that's largely due to a region-wide push to address one of the most difficult issues for both the Fed and American consumers, and that is the cost of housing and how it continues to go up. The story by Bloomberg News real economy reporter Mark Niquette, also Augusta Saraiva, wrote it for Bloomberg News. Mark joining us this afternoon on Zoom from Columbus, Ohio. So Mark, it turns out if you aggressively build housing, the cost of living goes down, the cost of that housing goes down?
Yeah, that's what they found in the Minneapolis metro area. There was a concerted effort to increase housing supply. They knew it was a problem years ago, and they set out to increase the supply of housing, particularly affordable housing. They had a region-wide effort called the Itasca Project, which was kind of a marriage of the public and private sectors and philanthropic groups that set out to add 18,000 new units in the market every year through 2030. And the mayor in Minneapolis said that one of the reasons he got into politics was affordable housing, believe it or not. It's one of his big passions. And since he's taken office in 2018, Minneapolis, the city, has done an aggressive effort to increase housing, including by eliminating exclusive single-family zoning so that apartment complexes essentially could be built next to single-family homes, not, opening up entire swaths of the city for additional housing.
First of all, it's nice to see a politician actually say they want to do something and make affordable housing and then actually do it, Tim.
And be successful at it.
Be successful.
This hasn't worked in places like, like here in New York. Governor Kathy Hochul tried to do this and got so much backlash, especially in the suburb of New York. How did he pull it off in Minneapolis?
Well, it wasn't easy, and he'll tell you, and he told us, that he's still being fought over it. There's a lawsuit challenging his 2040 plan, which includes a zoning change. There's plenty of NIMBYism in Minneapolis, St. Paul, as there is in a lot of markets, where folks don't want this multifamily housing in particular going up next to their homes. But there's sort of a different approach and philosophy in the region that, says, hey, this housing is good, and ultimately it's going to benefit the entire region, even if we don't particularly like it. And there's also a benefit that the region has. They have a regional council of governments, essentially a multi-county authority that has the power to enforce housing policy in the subdivisions, because each subdivision has to get its comprehensive plan approved by this council of government. So it's kind of a stick to enforce a housing policy as well.
Mark, as someone who's got a degree in economics, this one line in your story attributed to Moody's Analytics chief economist Mark Zandi, he says there is no more effective way to rein in inflation than to expand the supply of affordable housing and increase housing affordability. I get supply-demand metrics. Talk to us, though, about the housing affordability metrics.
Right. Well, it sort of starts with housing and shelter costs being a big component of CPI. More than a third, of inflation, comes from housing costs. So if you can address housing costs and affordability, you could really, tackle inflation, which is kind of what happened in Minneapolis, St. Paul. Their shelter costs in May went up 4% year over year in May, but it was half of the U.S. number. Which is a big reason why inflation overall in that metro dropped below 2%.
So to follow, because we often talk about, okay, wait, what's going on with the housing supply, right? And that's part of the problem that's out there right now, coming off the great financial crisis, right? Here we are, 13 years out or so. But that there's just not enough homes out there for people to buy, and that has caused housing inflation. But it's not just a simple number of housing supply, it's affordable housing, correct?
Affordable housing and also demand. Minneapolis, St. Paul has benefited from sort of a stable employment and population growth. Unlike the Sun Belt and areas that saw just a boom in population that put pressure on housing supply, the population growth has been pretty steady in Minneapolis and not put as much pressure on the need for available housing.
So I guess the question is ultimately, what has this done to the city apart from bring housing costs down? But that YIMBYs, yes.
Well, they can point to, housing prices and in particular rent growth being slower in the metro than other markets. Certainly other markets like San Francisco or other areas where, housing is just kind of a disaster. And it's a little more complicated than that because other components of inflation like food prices are still high. So you talk to folks on the street in Minneapolis and, say, hey, your inflation has dropped below 2%. Aren't you glad? They'll say, well, that's nice, but, the price of eggs is still very high. And, I still have trouble, buying groceries on the salary I make.
Right.
But overall, I think the sense is, a lower total inflation number is a good thing for the region because it shows that they are addressing the housing supply problem that they've had and they recognized years ago. And, prices, at least in the housing sector, are more stable than they are in other markets.
Hey, Mark, for those who are watching on YouTube and Bloomberg Originals, our producer, Ariagami, has been putting up some shots of Target. There are always sometimes to data points nuances, and if you will, or unique aspects. And so something unique, though, also to Minneapolis that maybe helps them out here in general is some of the companies that they have, right? Talk to us a little bit about that.
Yeah, they used to say, I'm not sure it's true, that the highest per capita percentage of Fortune 500 company headquarters. I don't know if that's true, but there's more than a dozen headquarters of companies, major companies like Target and U.S. Bancorp,
General Mills,
others in that market, which has meant essentially stable employment. Having the headquarters there means jobs, and that's also helped in the inflation number because if you have steady employment, that puts less pressure on the housing as well.
So what does a place like New York learn from a place like Minneapolis, St. Paul, or a state like California, where Gavin Newsom, just the last minute that we have with you, Mark, Gavin Newsom has pushed legislation and indeed made it possible to build ADUs in the state?
I think it's that, a little bit of acceptance of affordable housing, multifamily housing in your suburbs is not necessarily a bad thing. That if you can take kind of a regional approach to it and accept that this housing in your suburbs, for example, can be helpful. Because the other thing that folks in Minneapolis will tell you is that they see a benefit of having this affordable housing in the suburbs because the people who are living in this housing are the people they need to fill jobs at the hospitals and the fast food restaurants and the other employment bases. So essentially NIMBYism doesn't have to dominate everything.
Well, it's a great story, certainly ahead of tomorrow's CPI report as we really have inflation on our radar. Mark Niquette, thank you so much. Real Economy team reporter at Bloomberg News on Zoom from Columbus, Ohio.
Well, let's now get a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. A Utah man who is accused of making threats against President Biden has been killed by FBI agents. His death came just hours before Biden was to visit the state. The FBI says the man was killed while agents were serving a warrant on his home. He allegedly also made threats against Manhattan District Attorney Alvin Bragg, Attorney General Merrick Garland, and New York Attorney General Letitia James. An internal Trump campaign memo is front and center today. The New York Times is reporting the previously unknown document details how the Trump team, including his attorneys, hope to overturn election results in 2020. Bloomberg's Washington senior editor Wendy Benjaminson says the memo is quite detailed.
Laying out, let's get the fake electors going. Let's, have them vote for Trump instead of Biden. And yeah, the Supreme Court will probably overturn it, but by then it may not matter, which is really sort of surprising to hear, lawyers for the President of the United States saying this. And they lay out the plan to request Mike Pence to overturn the election.
Again, Bloomberg's Wendy Benjaminson in Washington. Many are calling a massive wind-driven wildfire Hawaii's worst national disaster in more than 30 years. Lieutenant Governor Sylvia Luke says the heavy winds are coming from a hurricane that's hundreds of miles away.
We never anticipated in this state that a hurricane, which did not make impact on our islands, will cause this type of wildfires. Wildfires that wiped out communities, wildfires that wiped out businesses, wildfires that destroyed homes.
Hawaii's Lieutenant Governor Luke, officials say the fires have killed at least 6 people on Maui. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We continue to monitor shares of Disney, the Walt Disney Company, reporting earnings, and the stock is down after hours right now, looking at a 2.3% drop in the Walt Disney Company. It did report third quarter earnings that exceeded analysts' expectations, benefiting from cost cutting and a narrower loss in its streaming TV business. But subscribers to the Disney Plus streaming service tumbled 7.4% to 146.1 million from the previous 3 months. That missed the 154.8 million consensus that analysts had been expecting. It was a down day on Wall Street today ahead of the CPI report tomorrow morning. The S&P briefly wiped out losses, but ended the day down 31 points, lower by 0.7%. Dow Industrials today down 191 points. That was a drop of 0.5%. NASDAQ down 162 points for the NASDAQ Composite Index. That was a drop today of about 1.2%. 10-year yield 4.01% right now, with a 2-year at 4.81%. Spot gold down 0.5%, $19.14 the ounce. And West Texas Intermediate crude oil rallied 1.6% today to $84.22 a barrel on WTI. So what about the market and what about interest rates? Paul Christopher is the head of global investment strategy at Wells Fargo Investment Institute, and he was a guest right here on Bloomberg Markets.
You know, if you get a downgrade at the U.S. and all of a sudden rates start to move higher, what's that going to hit? It's going to hit tech in equities. If you get concerns about inflation maybe popping a little bit higher, maybe the June 3% number was the low for the year, maybe that starts to make people second guess some of their positions, and they're going to start to trim.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcast. Checking Disney one more time. After hours, shares of the Walt Disney Company down now by about 1.9%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Keeping track of the earnings that continue to come after the close. A lot going on. It's not a sleepy August day, that's for sure. All right, so last year at this time, we were all complaining about how much airline tickets cost. High fuel prices combined with high demand, creating the perfect storm that led to eye-popping prices for domestic flights. I mean, come on.
Well, we thought this was going to continue this summer, and guess what? So did the airlines. But you know what? What a difference a year makes. U.S. round-trip tickets cost about $257 on average. That's below both last year and the pre-pandemic levels of 2019. That's according to a consumer travel index released Tuesday by the booking app Hopper. Carol,
no offense, but I've looked at some round trips, not 257.
Well, I know who you can talk to about this.
All right, so who are we going to talk to?
All right, well, we got Haley Berg, lead economist at the travel app Hopper, on what's driving lower domestic airline prices. She joins us on Zoom from Boston. So why aren't we seeing this, Haley? Are we not buying tickets to the right places? What's going on here?
I'm just going to say I had to look at tickets for
over
to you. I know.
Carol, here's how Carol buys airline tickets. She's like, I'm going here, tomorrow, next week, I need a ticket. That might be your problem, Carol, is you just put it off too long.
You do have a point. All right, Haley, take it away.
You have nailed it, actually. A lot of Americans don't feel like they're seeing these low prices, and it is because a big change in consumer behavior coming out of the pandemic is we plan trips more last minute. We were used to doing it during 2021 and 2022 when things were more uncertain. But what it means is travelers are missing out on the lowest prices that are typically available on domestic a month to 2 months before departure, and on international 4 or more months. So though we are seeing average prices, yes, around $257 on average, down more than 10% from previous years, some consumers aren't seeing those, in part because of their own behavior.
All right. Unfortunately, we've got some news we've got to get to, Haley. So we're going to get back to you soon. Haley Berg over at Hopper. Disney, though, stock's down about 2% in the after hours, but a headline just crossing in their analyst call that they are raising prices for streaming services by as much as 27%.
Wow. So starting October 12th, the ad-free version of Disney Plus is going to cost $14 a month. That's up from the $11 that it currently is. That's according to what the company said on its earnings call. The ad-free version of Hulu is going up by 20% to $18. Wait a second. I just started paying more for Hulu again, Carol. This is the second price increase for Disney Plus in less than a year. Oh, also, we started paying more for Disney Plus too recently. It also underscores the company's drive to make its streaming business profitable by September of 2024. You can still get Disney Plus or Hulu with ads. That's at $8 a month.
I'm just looking at, a great story in the Bloomberg breaking down the structure from Disney Plus, Hulu, ESPN Plus, like the different variations. So you're looking at monthly cost, depending on with ads, no ads, anywhere from $8 to $25. You want Disney Plus, Hulu, ESPN Plus, no ads, $25 a month. That's what it's going to cost you.
Well, okay, but you're getting three things there. I mean, I probably should get that because we pay for Disney Plus without ads and we pay for Hulu without ads. And the two of those together is going to be $30.
All right,
More than $30.
Disney's still down 1.8% in the after hours. Let's make some sense of it against what feels like it's been a 24-hour news cycle of a lot of Disney news. Bloomberg Intelligence Technology and Media Analyst Geeta Ranganathan joining us now from BI headquarters in New Jersey. So Geeta, this headline crossing, I don't know, what does it mean to you as an analyst who follows this company so closely?
It tells me, Carol, that they have pricing power and they know it and they're going to exercise it. And this is what it's really coming down to now in the streaming wars, right? The subscriber hyper-focus is over and done with. Now it's all about ARPU, growing revenue per user, and that's exactly what Disney is doing. This should pad not only the top line, but also the bottom line.
Okay, I'm not going to defend Disney, Geeta. I'm not going to defend any of the companies that are raising prices left and right here. But I am going to point out that in the previous life, when there were no streaming services, when we were just paying one single cable provider every year for everything, they raised their prices every year and no news was ever made.
Yeah, but they did it gently.
They did. And they're not around it.
I don't think they did a 27% increase. They did it like 3 to 4% every year.
So this one, do you expect this to lead to churn?
So it might lead to some churn, I think, on the margin, but I think this is really where all of the streaming players are headed, right? So it's going to come down to a shakeout, and Disney and Netflix are actually going to force that shakeout because at the end of the day, you're only going to be able to spend X amount of dollars per month on streaming, and they're basically telling you, choose, make your pick and see which are the services that you want the most, that you need the most, and they're hoping that Disney and, maybe Netflix is hoping that its service will prominently feature there.
It's really interesting, right? Because we also, and I want to take the bigger picture of Disney, their post-earnings, the things jumping out at you, because they did report, right, their loss from streaming narrowed by half to $512 million in that fiscal third quarter, but it was still far less than what management had forecast about 3 months ago. Give us all the picture that is Disney and how you see it.
Yes, I think, this quarter was really more about, of course, we knew that the numbers were not going to be the greatest. Having said that, though, of course, the profit numbers did come up slightly better than expected, as you just pointed out. The streaming subscribers, however, was a miss, but I don't necessarily think that's a bad thing because the subscribers that they lost were really 12.5 million subscribers lost on their Hotstar product, which is, their Indian service. That is a very low revenue generating product, so it's not a high value subscriber that they're losing. And so I think that's okay. The street is kind of okay with that.
But sorry to cut you off there, Geeta, but shouldn't the street have expected that because they came in substantially below estimates, the street's estimates? Shouldn't that have been baked into the estimates?
They did bake in, about 3.5-4 million losses. This came in, of course, substantially higher. So cricket, I think they kind of underestimated the power of cricket in the Indian subcontinent.
Okay.
What else is important? We see Disney, though, lower in the aftermarket. What else do we need to know? And unfortunately, only got about 45 seconds.
Yes, I think the other key thing that we really need to look at is parks and what are the trends at parks. Parks actually brings in 70% or 75% of Disney's operating profit this year. So it's really key to understand what the trends are looking like. I think in the domestic parks, we are seeing some softness. That was kind of offset by international strength because this was the first time that we had all of the international parks open after all of those COVID closures. But it's going to be interesting to see what exactly they're saying about attendance and occupancy rates.
The transformation at Disney, a new Disney, it's underway. Did we lose Geeta? Oh, is it underway, a transformation
I definitely hope so, Carol. So it's going to be all about the strategic vision. We're already seeing some of those pieces in motion with the ESPN deal. We'll have to see what they do next.
You're incredible. Geeta Ranganathan of our Bloomberg Intelligence team. Thank you.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. We continue to keep an eye on shares of the Walt Disney Company after hours. Disney stock now down by 1.9%. Wendy's shares declined today after the fast food chain reported second quarter global same-store sales that missed estimates. And with more on the Wendy's story, here's Tom Busby.
Charlie, the fast food chain reported second quarter global same-store sales that missed estimates. Now it still sees global system-wide sales up 6 to 8% for the year. Revenue last quarter coming in at $561.6 million. Estimates called for $566.8 million. Wendy said it raised prices in May and expects a 7% rise for the full year. It also said it sees a mild recession or maybe none at all. Charlie.
And that's Tom Busby reporting. Wendy's shares today lower by 2%. Rival McDonald's down 0.5%. Yum Brands, the parent of KFC, Taco Bell, and Pizza Hut lower today by 0.6%. The gaming platform Roblox reported a daily active user count and hours played that came up short of analysts' expectations. Roblox shares plunged today by 22%. Carvana has raised its profit outlook as the used car retailer said the momentum it saw from an early year turnaround is carrying into the third quarter. The revised forecast comes 3 weeks after the company reported better than expected second quarter earnings. Again, Disney after earnings after hours down now by 1.7%. And those are the top company stories we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week. I'm Tim Stenovec, joined by Carol Masser. Let's get a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Well, President Biden says thanks to Congress, money is being pumped into wind projects, an industry that had been contracting. Bloomberg's Irv Chapman has more on Biden's trip to Utah.
The president stood in front of a projection of wind towers in action as he extolled wind energy.
COSA makes wind turbines, wind towers. That's a key component. Those blades are 103 yards long. And by the way, they don't cause cancer. And wind energy is cheaper than fossil fuel.
The president said more investment will also go into expanding the grid to take the electricity from where the wind blows to where it's needed most. In Washington, Irv Chapman, Bloomberg Radio.
Just hours before Biden's visit to Utah, the FBI says its agents shot and killed a man who had allegedly threatened to kill Biden. Officials say the shooting happened while special agents were serving a warrant on the man's home in Provo. A newly released memo obtained by the New York Times shows how former President Trump and his allies sought to overturn the results of the 2020 election using fake slates of electors. Greg Valliere with AGF Investments tells Bloomberg this memo should concern the Trump legal team.
You can make a case for a conspiracy that one of these 6 alleged co-conspirators had a big role in this. And I think if a conspiracy case looks more likely, you have to ask the question, could 1 or 2 of those 6 cop a plea?
Greg Valliere with AGF Investments. Robbie Robertson, the lead guitarist for the band, has died. He was 80 years old. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Tim.
All right, Nancy Lyons, thank you so much. Carol Master along with Tim Stenovec here at Bloomberg headquarters in our Interactive Brokers studio on YouTube and, of course, on Bloomberg Originals. Watching shares of Disney, they're not at their worst levels in the aftermarket, but still down about 1.1%. But they are bouncing around.
Well, they're getting more details as we continue to learn more about what the company's plans are. The latest, though, Disney raising prices for streaming services by as much as 27%. So that means starting October 12th, Disney Plus is going to cost $14 a month. That's for the ad-free version. That's up from $11 a month. And then Hulu is going up by 20% to $18 a month.
Yeah, it's interesting, too. And the call obviously underway, and we're seeing some headlines cross. The interim CFO, Kevin Lansbury, speaking on the call with analysts, probably leading that conversation. He, among the headlines, they sold their investment in DraftKings, recorded a $90 million gain.
Kind of makes sense that they sold their investment in DraftKings ahead of teaming up with Penn, right?
Yeah, it all just like the pieces start to fall in place. Expects better improvement in direct-to-consumer losses mid-fiscal year 2024. Sees direct-to-consumer ad sales partially offsetting fourth quarter linear decline, so that goes back to linear broadcast TV and so on. Expects parks margins in the fourth quarter to exceed prior fourth quarter 2022.
Okay, so we're continuing to get more headlines. Disney expects fiscal year 23 CapEx